as shareholders and investors, right, we always try to look for things that will increase shareholder value, lead to capital gains, increase dividends, and stronger reports. But one of the big things are acquisitions, right? But
Right.
anyone who knows business knows that as much as an acquisition can work and lead to an increase in shareholder value, a lot of things can go wrong, and acquisitions can be capital destructive. If you look at a lot of, like, even in the United States, if you go back to their stock market, a lot of companies were over leveraged, made acquisitions, and it just didn't work out. But you have been someone, and through the PanJam group and just all of this stuff that you've been talking about, you have made some good, I'd say, good acquisitions. Could you speak about what makes an acquisition, or what makes a good acquisition, what makes a bad acquisition, and maybe even talk about some of the acquisitions you've made in the past?
So, there's a sense in which it may, to some extent, be in the eyes of the beholder, because you have to we think you have to bring yourself to the acquisition. The things that Elon Musk wants to buy, that from his particular skill sets are not necessarily suitable for me.
Mm-hmm.
And so, what do we look for? You could ask. What we don't want are businesses that rely on a single individual or some kind of specialized talent. So we're not going to buy a business that relies on somebody's sales network. They're a broker, or they're an expert coder, who knows what. So we are interested in tangible assets with something special about them, but that thing is not about any particular human being, but it's about something that you can buy that's special. So if you're going to buy into Kingston Wharves, well, they have 1.7 kilometers of berth space on the city of Kingston, which you can't easily buy tomorrow morning. And so if you want to, find a parking lot for a ship with 2,000 cars, you can't just pull up that ship, out at Harbour View. So you got to have something that's pretty organized to do that. And, fortunately, we're blessed with a natural harbor, but we had to invest a few $100 million to make it appropriate for what we do. And so we look for businesses that have that kind of capital. And then we like to get value deals. We like to pay a little bit less for them than you might think they're worth. And in valuing them, we like to do what we call burden the model. So we build a financial model, but then we assume that a lot of things are going to go wrong. We don't assume everything is going to go well. And the way we look at it is we look at kind of what we call year one earnings. So we're not interested in what's going to happen 3 years from now. We don't do a growth rate which we apply and assume that the world is going to be good. And, a lot of people will take a business earning $1 million and then they'll say, let's assume that it's going to grow by 10% a year for 5 years. And the costs are going to stay more or less steady and we're going to make lots of money. And then they value that. We don't do that. We just assume it's not going to be a lot better than year one. And year one is the year in which we can pull visible levers that we know and get a very specific result. And then we take that number, which is the year one earnings, and we multiply it by 5 or 6 or maybe 7, which essentially the inverse of that is a rate of return, which is about 15%. And we think long and hard about working capital, and making sure that we don't buy the business and then realize that people owe it money and it owes other people money, and we have to find ourselves putting money into the business to keep it going. So we obsess over the working capital. And then we want to make sure that the business is comfortable with our way of working. And we have a very specific playbook, which is, in the case of Jamaica Producers, is called the JP way. And lo and behold, in the case of PanJamaica, it's called the PanJamaica way. And basically it says what our expectations are of management and of the governance arrangements. So essentially for each of the businesses that we're invested in, we must have, monthly meetings. We must have reconciled financials. We must have certain policies around the way we engage whistleblowers, anti-harassment, conflicts of interest. And for all of them, we have them document a 3-year vision. So we want people who are comfortable having these kind of strategic conversations. And then we make sure that the business can have a general manager that we're comfortable with and a finance person that's a partner of a general manager that's comfortable being transparent. And that's our kind of bag of tricks. As far as examples that have been demonstrative, I think to use an example that's complete, meaning we're no longer in it, just to kind of give you a closed loop, we can talk about anyone that you want to talk about, but Mavis Bank would be a good example. And Mavis Bank is a good example of a theory that we have, which is that we look for businesses that have all the characteristics I described, but have the wrong shareholder. The wrong shareholder could be that they're owned by a family and the business has just grown to a point where the family isn't really that comfortable with it anymore. The wrong shareholder could be a multinational that has just woke up in the morning and said, this business is no longer core to us. The wrong shareholder could be that its shareholder is financially distressed and needs money. And these are all these are actual cases. So in the case of Kingston Wharves, it was the final block that we bought was from NCB. And NCB said, well, we're a bank. What are we doing owning a port? They had gotten involved for some other reasons. Our juice business in the Netherlands was owned by a multinational that said, we don't want to be in fresh juice. We're going to focus on dairy. Geest was owned by a company that had gone bankrupt. And the administrator, the receiver, said, listen, whoever's going to give me some money next week, Tuesday, can have this business. So we bought it on Zoom. And away we went. In the case of Mavis Bank, the wrong shareholder was our government.
This is Mavis Bank Coffee, right?
It was
okay, just for the shareholder, just for
Mavis
the
Bank
viewers.
Coffee Factory. So it's a factory in the mountains, in the Blue Mountains, that was buying coffee from, 5,000 farmers in the Blue Mountains. And it was the best coffee in the world. And it had a significant market share, market leading position. And the government of Jamaica found itself owning this business because the coffee farmers and this coffee factory, there was an era in which it was a commodity business, so it has boom and bust cycles. But there was an era in which people were trying to get the coffee and it induced everybody to borrow lots of money, and they borrowed lots of money, and then there was an adverse business cycle. They couldn't pay back the money. And instead of allowing the business to go bust, the government stepped in because it needed to, because there were a whole lot of growers in the mountains with families. But it was still Blue Mountain Coffee. It just had a bad capital structure at the time that the government got involved. But the government held it and tried to manage it. And, when government manages things, it's more inflexible. And so it was loss-making. Government just wasn't the right place to run a business like that. So we were able, because it was loss-making, in fairness to the government, they did the right thing. They sold it for $890,000 to a joint venture between Jamaica Producers and PanJam. We were just friends. And but they trusted us to be the operators, Jamaica Producers, because of our agricultural background. And then we were able to reprice the coffee that we're selling to third parties. We were able to streamline the factory, to hold the team accountable. It was the same management team, but we focused them a bit, and they did a good job. We're really proud of working with them. We were able to turn it around to the point where it started to make a couple of $100 million Jamaican in profit in a year or two. We were able to get dividends of about $4 million between the two of us over 4 years and sell it for $15 million 4 years later, by which time it had really turned itself around. Now, we don't normally sell businesses unless we get an offer from somebody who has a vision that they can capitalize on the business at the price at which they're willing to pay for it. and that price is attractive to us. So we're not private equity in the sense that we're not looking to sell. But the buyer was a responsible company, and they themselves had synergy value with another coffee business. So that was the kind of the full life cycle. It had all the elements. The element of wrong shareholder at the time when we bought it, the element of being able to benefit from our governance arrangements, and the element of a conservative valuation. But if you look at all the deals we've done, it would be the same story. If I were to
Wow.
Not necessarily the level of success. We've had more success with others and less success with others, but the formula that's worked for us, you know, if you look at Geest, it was loss making, it had an insolvent shareholder, we bought it, we put in our governance framework, we worked with the team, it started to make money. The juice business was loss making, wrong shareholder, very unique juice business, not a normal juice business. So it had a capital that was special. We got it to make some money. It's doing quite well now. So that's the formula.
Okay.
Feel like
Thank you for sharing.
It's not. I can't find any more deals on this call.